Yeah, hello everybody again. This is, you know what that is. The boring channel with lectures on taxation. And today something especially boring, but perhaps also a bit interesting. And namely, today our topic is value-added tax. That will be based on examples from German value-added tax law, but it is usually the same all over Europe in principle. At the beginning, Chapter 1, the system of value-added tax. So, what it's all about. Here's a short overview of the bullet points we are going to speak about today. The system of value-added tax as an indirect tax, the importance of neutrality for competition, and competition neutrality in an international context, which consequences follow from that. Okay, so let's first remember the three basic types which exist in taxation, or the three basic types of taxes. There was first taxation of income, taxation of wealth, so taxation of consumption. If you look at that, you see your tax legislator really is your permanent companion. When you get money, you pay taxes, taxes on income. When you have money, taxes on wealth. When you spend it, you give away a bit of it as taxes on your consume. Yeah? Consume taxes is now the area where we are today and in this lecture. Consume taxes are, for example, excise taxes. So taxes which are levied on special goods, because the idea originally usually is who is able to buy such a luxurious good like tobacco can pay a tax, or coffee, or mineral oil, or such things. Indeed, when you go back in history long enough, then you see tobacco originally came from countries which were far away. So it was a product for wealthy people, and so it was an indicator that somebody was evidently a bit too rich, and then state says, okay, you can also give a bit for the poor. That means me, the state. Coffee, the same, a product from somewhere far away from the other end of the world. Oh, that's fitting now. I subconsciously take a cup of coffee when I speak about coffee tax. Naturally, um, you regard this as a luxurious product. When you go back some 200 years, everybody sat in the evening in the dark, 10 people sitting around a small candlelight. And the difference between the old grandma who is blind and the young child who is healthy and has still a good eyesight begins to vanish with the burning down candle. Now electric light is invented. Great advantages. First, it's modern. Second, you can turn it on and that's really something like light, not only a candle. And third, great advantage, if you by chance just hit the light bulb, your house and the whole town doesn't burn down, what always happened with candles. So really luxury. So naturally also that entails a special tax on light bulbs and electric light, and so on and so on. Champagne, wine, beer. And now it can't surprise us that, well, some people get intelligent over time or use their intelligence. And then they found out, okay, from the perspective of a fiscal ministry, evidently everything which you buy is a luxury product and deserves a tax. And the only reason why they don't tax the air which you breathe is you can't measure it. And so theoreticians sometimes have this idea and this approach. Somebody said, okay, that's where it will end up. Now, let's take up some speed and do it honestly. Just write down a text that we are going to tax everything which you buy, irrespective of if it's luxury or not, because from the perspective of a good fiscal ministry, everything is luxury. And so we should replace all that bundle of thousands of specific taxes, where you have to learn all these tax laws. And every sector of economy has to follow an own tax law, or two, or three, or 10. Just to simplify matters, we should invent a tax on everything which is consumed, and that was the birth of value-added tax, or as it also called, turnover tax. Everything which people spend for consume was meant to be taxed. Now, that's easier said than done, because how do you organize that? Imagine you have some 5-year-old child who just bought some sweets. How can you follow up that in a tax declaration? So that is a general problem with taxes on consume. They are usually organized in the form of an indirect tax. So the basic idea is, or the basic insight is, well, if you want to tax every consumer in a way that every consumer has to fill out a tax declaration regularly, for example, every month, and declare their consumption goods, of goods or even of services. First, how do you explain that to every consumer? There are not only intelligent people in the population, sometimes they are rather below average. By the way, statistic professors would say, yeah, half of the population must be below average. That's probably the truth. And so you can't expect them to be able to. And the other half will be the intelligent ones. They are going to lie about it, and you can't check it. So a tax on consume under that aspect sounds rather hopeless. But luckily, look to the following equation. The cash outflow of the consumers is the cash inflow of the enterprise owners, of the entrepreneurs. You can also say the same equation as expenditure of consumers is sales revenues of entrepreneurs. And now you have the decisive logical point where you can catch the whole problem and solve it. The legislator could just replace the tax on the consumer expenditure by a tax on the revenue of the entrepreneurs. And this is then automatically the same. Now, this way, you only need to ask one entrepreneur to fill out a tax declaration of their revenue, instead of asking thousands of stupid consumers to fill out tax declaration on their expense, which you can't check, and so on. By the way, and the entrepreneurs even have books. So there you can find the revenues and you can check it, because you can even check the plausibility, because when they try to cheat, you can find out via their books and their business contacts what they bought, and so what they probably also sold later. So there are huge possibilities to control the whole thing. Your situation is far better, and so that is usually the approach. Now, when you tax the entrepreneurs and say 100 euro always causes a tax of 20 euro on top, then the expectation is natural that the entrepreneur regards that tax as costs and increases the prices by the amount of the tax in order to to cover or the additional tax costs, so to compensate the additional costs caused by him by the tax. Now, as a result, the entrepreneur does not sell anymore for 100 euro, but for 120. And so indirectly, by getting charged the higher price, the consumer pays for the tax. Not officially, but indirectly, because the financial burden from the tax is shifted via the increased price to the consumer. And that is the concept of an indirect tax. It's even built in, and it's even the plan of the legislator. You can, for example, also say, okay, if I earn 50 euro an hour in my job, and or if I want to get 50 euro an hour in my job, first, congratulations, might be nice. But my legislator takes away 50% as levies in form of contributions and taxes, then I just increase my hourly fee from 50 to 100. That might work. Depends on the market and how much a genius you are. But usually that's not what is the idea behind income tax. There they want to tax you. Now with an indirect tax, the expectation is even built in the plans of the legislator that the tax shall be shifted onwards to the consumer. So an indirect tax would be a tax where the person who is legally the taxpayer is different from the person who, according to even the plans of the law, is expected to end up with bearing the financial burden of that tax in the end. So the term indirect tax describes exactly that. The legislator has planned that the official and legal taxpayer who has to declare the tax and organize the payments and so on shifts over the financial burden to somebody else, to the consumer. Good. Now, after that has been said, let's think about how we would organize such a tax. The idea is, what do we have to observe if we want that such a tax functions properly without ruining everything? The most important principle that we need to have in mind when it comes to value-added tax and all other indirect taxes is neutrality for competition. That is decisive, or that underlies most fundamental ideas of the present day turnover tax or value-added tax system. So you have especially three major forms of neutrality of competition. First, the principle of neutrality for competition between two entrepreneurs in the same country. The neutrality of competition in an international context. And you have to make sure that neutrality of competition also is guaranteed in a chain of entrepreneurs, or between two chains of entrepreneurs which have a different length. So, to sum that up, the most important idea behind any indirect tax is it is expected that the entrepreneurs pass on the tax burden via the price to the consumers, and that's even the plan and not an unwanted side effect. That is the difference to income tax and wealth taxes. Now, how does that work? Imagine you have an entrepreneur who has costs of 90 euro and requires a profit of 10 euro to survive or so. So she sells her products normally for 100 euro. And now a tax comes on top of 10 euro. Because she knows that this tax needs to be paid, she calculates the prices now differently. Yeah, my costs are 90, my necessary profit, or the entrepreneurial wage, or however you call it, the profit she needs to survive is also a kind of cost. It will be in the calculation. Additional 10, so my net price, my total of costs up to now, is 100. Now I will have to add the tax of 10. So my final price, which I must demand from the consumer if I want to survive, is 110. By the way, this is called the gross price, whereas the price without the tax would be the net price. Please memorize these technical terms. They are important. You should and must always know what a gross price and a net price is. So gross price is always including the indirect tax. Net price is without. So the amount before you add the tax. Good. Now let's turn to why neutrality for competition is important. Let's just try to imagine what would happen if we violate that principle, because then you can usually understand why something is necessary. If you just abolish the thing for a second and then play around and find out what is going to happen if the principle doesn't exist. So we decide now that we have two entrepreneurs, and one is charged with a tax of 10 on the products and the other one 20 on the same products. So if both entrepreneurs are equally good, equally skilled, can work with the same cost, then we have the following effect. Entrepreneur A has costs of 90, profit necessary of 10, 100 net price, tax of 10 is added. Entrepreneur A can offer for a final price of 110 the products to the customer. B has the same cost of 90, demands the same 10 to survive. 100 is the net price. The tax is now 20 on top because our legislator just decided to do so. So B can only offer for a price of 120. Now, it's a reasonable conclusion to ask yourself, where would you buy only from entrepreneur A? So B will not be able to sell anything at all. In the long run, B will vanish from the market. So it makes, in the long run, absolutely no sense to demand two different taxes from different entrepreneurs. The only effect you have is you kill a bit of your entrepreneurs and leave the others surviving only. So if you treat them differently, you just eliminate some of your entrepreneurs out of the market. The rest, those who will survive, will be those who have the same competition conditions. And so, well, if that is the final result, you can start with that from the beginning and say, okay, I treat them all alike. You must treat them all alike if you don't want to eliminate people from the market. So if a law is not meant to drive some of the entrepreneurs out of the market and into bankruptcy, then the tax must always be designed in a way that is neutral for competition. So two people who are equally good without the tax should stay equally good after the introduction of the tax. So that means exactly what I said. Equal prices before should mean equal prices after the tax. Otherwise, you would change the attractivity of the entrepreneurs to the consumers. On the other hand, if without the tax, entrepreneur A would be better than entrepreneur B, that sequence should not be changed by the introduction of the tax. So if the tax is added up to the prices by both, the sequence should still remain the same, that A remains better than B. Otherwise, people would survive in competition, which without the tax would have to leave the market. And this is also a distortion and brings negative effects in the long run. So therefore, you need competition neutrality. That's the tax must not change the position of the entrepreneurs with regard to competition. Now that's easily said. How can it be done? The tax must be equal for all entrepreneurs in equal situations. That is what we directly know. But how do you establish that under a technical aspect? The first idea is demand the same absolute amount of tax from everyone for the same product. For example, in Germany, we have a coffee tax. That's peculiarity here in Germany. That tax survived. Many others on special products were abolished at the beginning of the 1990s, but that tax survived. And so there is simply a rule that every kilogram coffee which is sold in Germany costs or is charged with €2 and I believe at the moment 19 cents per kilogram. So that naturally is a classic example for not changing the hierarchical sequence of the entrepreneurs. Or the other solution is just look to the net prices and then add the same percentage on top. Because then even the distance between two entrepreneurs is not changed very much. If somebody is 20% better than a competitor, then after adding 20% on the prices of both, you would again be equally better by 20% in comparison to your competitor. And two people with the same prices would also have the same thing. So, or third possibility, you combine the approach A and B. For example, you say every product of a certain kind is charged with €10, and additionally also I take 20% on the net price in addition to that. These are the possibilities. So let's begin and look again on that coffee tax example. The tax on coffee is €2.19. So if you have two sellers which have net prices of €2 each, then both can offer for €4.19. So equal stays equal. But if one seller can offer for €1 and the other for €2 without the tax, then the one will be able to offer after tax for €3.19 and the other for €4.19. So better stays better. So approach number A fulfills exactly the requirements. B, value-added tax in Germany is 19% on the net price of all products and services. And, well, some is 7%, but we ignore that. But if you have two sellers who have a net price of €10 each, then both can after tax offer for €11.90. Equal stays equal. And if vendor A can offer for a net price of 10, vendor B must demand a net price of 20, then after tax the one can offer for €11.90 and the other one for €23.80. Better stays better. So both approaches fulfill the requirements of neutrality for competition. To sum this up, plain and simple, the principle of neutrality for competition, ladies and gentlemen, demands that all entrepreneurs who offer a certain product or service must be treated in a way that their chances are not changed by the tax, and that requires either a fixed amount per product or a tax which is levied as a percentage on top to the net price. By the way, here you now see or can already imagine that a tax on every kind of product or service cannot take approach A. You cannot make huge lists of every potential and possible product and decide on how it is charged. Simply impossible, because the number of potential products and services is indefinite. And also for the approach A, euro per unit, you need to be able to define and measure the units of the product. With coffee, that can be done, but imagine tax advising or legal advice for a divorce. How do you measure that? Are you going to say the one has heavy arguments or heavy problems? Take some technical instrument and try to weigh the problems. Do you want to charge a legal problem according to its kilogram of paper? So absolutely impossible. There you can only use the price, and that is the reason why value-added tax, in contrast to tobacco tax, taxes on electric current and mineral oil, and so why then that is always defined over the price percentage approach. Good. So that's clear. Now we know why our value-added tax system will be defined in the way it is. You will charge everything with an equal percentage in order to guarantee neutrality of competition. By the way, you know perhaps that there are some products which are charged at a lower price, lower percentage, but then that lower percentage is again valid for everybody who offers that category of product, and one takes great care that this category of products not directly competes with other fully taxed alternatives. Good. Now, international context. Are there consequences which we have to draw when we live in a world with open borders? Well, the answer is yes. There is no area where you are alone in the world. So it's always good when you design a tax system that when you develop the basic ideas, you directly take into account the fact that you are not alone. So what happens in an international context? What does neutrality for competition as a necessity bring along automatically for your relations to the rest of the world? And the answer is, we must first see what the problem is. Indirect taxes require that every supplier is taxed under exactly the same rules, otherwise there would be a deviation. But now you don't get foreign laws to apply your own laws, foreign countries. At the border, your legal capacities are all over and gone by. Beyond the border, there is another game going on. So imagine the German VAT rate is 19%, but the Swiss levy only 7.7 or so. Or some years they did it, they took 8% or so. Now, how can one ensure that a Swiss entrepreneur with a net price of 100 and a German entrepreneur with also a net price of 100 can compete under equal chances after tax? Seems to be impossible. The Swiss is charged with 7 and the German with 19. So let's start a thought experiment or a Gedankenexperiment, which is, as I believe to have heard, even an English word, the nice word from the nice German word Gedankenexperiment. It sounds like physics. Einstein preferred to do Gedankenexperiments, and so we do once in our lifetime something which also Einstein would have done. Gedankenexperiment. We imagine for a short moment that every entrepreneur worldwide would have to apply only the laws of his or her or its, in case of a company, home state. What would then happen? So the Swiss is taxed under Swiss law, the German under German law, the Danish under Danish law. Imagine what is going to happen. So we have the customer naturally waiting here for offers from the entrepreneurs. We have a German entrepreneur and you have in mind 19%. The German calculates and says my price is 119 because I have costs of 119 come on top. So this is my price, dear customer. Think if you accept my offer. The Danish comes forward and looks into his law and his cost calculation and says, okay, my price I can offer is 125 because, sorry, there is a typing mistake. It should be 100 plus 25, 125 customer. Now customer has an easy choice, but then the Swiss comes and enters the scene. 7.7. Our Swiss has 107. 7, not 19. Again, the same copy and paste mistake. Okay. I just wanted to test your mental abilities. So now our customer has the choice between these three offers. It's a natural question. Where will our customer buy? And the answer is, well, he buys naturally from the Swiss. That brings along the question, what happens to the others? And this is relatively easily shown. The others will die out. The German and the Danish have no chance nowhere in the world because wherever you offer with 19%, the Swiss also arrives and hands in an offer with 7.7%. So even in Germany, you have no chance. The Swiss will always be there. So that is already a clear conclusion. If we organize our tax system in such a simple way that everybody pays value-added tax for all his, her, or its sales at home, then you can directly kill nearly every business owner in the world because there will always be one country which is the cheapest, and that will outperform all the other business owners. You would have only one potential reaction to counter this and keep your entrepreneurs alive. You would have to turn into the country with the lowest rate. So Germany could only survive by lowering the rate to 7.6. But naturally, the Danish would also grasp the idea and say either we kill them all or we renounce on much tax and can live with 7.5. By this, the Swiss would change over to 7.4, and in the end, it would be clear the world could only survive with 0%. So below the line, one conclusion is absolutely clear. This could never work. So it needs to be secured that foreign entrepreneurs can never supply cheaper than to a domestic customer than the own inland competitors. So Germany would have to make absolutely sure that no foreign business owner could ever make an offer to a German customer which is less taxed than the German competitor. Otherwise, you would just, you would just kill your own industry and own businesses. So how can that be done? That's the question. How can it be secured that all foreign suppliers bear at least a tax which is equally high to the inland tax? Two potential ways exist. First, negotiate with all states of the world that the indirect tax laws of all states of the world are exactly the same and that also they are enforced with the same strength, same strictness. So that would be the approach of a full harmonization of all indirect taxes. The other way would be subject all foreign suppliers to your own inland tax law. Because then it would be clear they can't get away with offers to inland customers cheaper than your own people. Now, realistically, we can say approach number one is a bit unrealistic. Mm. You don't get 200 states in the world to agree on absolutely identical rules for every indirect tax, so forget about that approach. Then only approach number two is potentially possible, and that is possible to say we oblige all people selling goods into the inland to pay the taxes of our country, and it's even possible to check and control it, to enforce that. You would have just to watch the border and look at everything which comes in and charges with the tax. Indeed, that is done with every indirect tax. For example, when you bring sufficient amounts of coffee from a non-EU country to Germany and you are at the airport, you will probably be charged with coffee tax on the, let's say, 100 kilogram coffees which you transport into the inland. You can't escape that fate. With value-added tax, exactly the same is done. If you bring goods into the inland, you will be charged with inland value-added tax on the border. So that's the realistic way. All countries probably who have indirect taxes levy importation levies at the border. In Germany and other EU states, that would be importation value-added tax, which is exactly the same amount as the inland value-added tax. The only peculiarity is this tax is not taken from the entrepreneurs, but from that person who crosses the border with the good in his possession or her possession. Now, how does that change the game? We have the customer again, and you see here the inland calculation. The offered price is probably 100 plus 19, and we see our open question, how will the client react? Let's now think of the German entrepreneur, cost 100, offered price 119, plain and simple, customer gets that offer 119. Now we have the Danish and the Swiss also entering the game, and they go forward and they come to the customs office and hear of the German domestic tax of 19%. So they have to add 19% on their products and can no longer be cheaper than the German competitor. So where will classic client now buy? Well, the German is now no longer chanceless because the German is charged not higher than the foreign competitors. They are not able to be cheaper. Okay. Conclusion from that, all imports have to be taxed in the country where they go to, otherwise neutrality for competition cannot be upheld, and otherwise your system goes to chaos. Exceptions, you all have already crossed once or twice a border without paying taxes, and the market didn't break down. Exceptions are possible only for reasons of simplification. So where, for example, the costs of levying the tax are higher and then the danger or the damage done by that one and only product entering the market without the proper taxation. Imagine a typical example that a traveler bought a small salami in Switzerland and now wants to carry that over the German-Swiss border into German inland in his rucksack. And the salami has a very, very low value. High calories, low price. Now, you can simply bring forward, okay, that's a problem for the German market and the fairness of competition, but well, just to be realistic, that's not a big problem. It's only a small salami, and the problem will be eaten up half a day later. So that's not the big impact on the German market. So allowing the importation on that single salami without big procedures at the border can be tolerated. Being exact here would probably cause enormous costs. The people would queue by kilometers, and the fiscal revenue which it brings would probably be 12 euro per hour or so, or 10 euro per 100 travelers. So my recommendation would be don't do it. Huh? You can justify it simply if you buy a single salami in Switzerland. Okay, tomorrow you buy the next salami again in the inland. You will not travel to Switzerland just because out of the salami. But naturally, when it's no longer a trifle, when it is something what matters, for example, 500 salamis, okay, well, that's different. So then you should take the efforts and tax it properly. And it's actually that is how it is done at the borders. Small, trivial quantities of foreign goods are allowed to come in. Whereas when you exceed a certain amount of value with the products which you bring in, so that it really matters, then the customs officials would say, okay, please come to the site and sit down, let's fill some forms, and here is, let's call it the invoice, here is the VAT which you owe us on the goods in your possession. So usually full taxation is a basic principle. Everything which crosses the border should be taxed. Yeah. So one question automatically arises. Does this widespread or even exceptionless principle, every country of the world where the fiscal ministry is not completely mad will have importation taxes on the borders? Does this also require consequences for the treatment of exports? And the answer is, if I ask you so, probably yes. Let's again start a Gedankenexperiment, a thought experiment. What if exports are still regularly taxed in the country of origin? Then we have here again our German entrepreneur living quietly and peacefully within Germany, and he or she can offer a product for 119, including VAT to a client, to a customer. The Danish and the Swiss are sitting behind the border and waiting for chances. But here is now customs duties in the way, and if they cross customs duties, they have to add 19 to their product price. 19 also for the Swiss. Now imagine they are also taxed in the country of origin. So imagine for our Danish entrepreneur, 25 Danish tax come on top. Or the Swiss would be charged with 8. Let's round it up to 8. 7.7 is a bit inconvenient. So in that case, the Danish would end up with a price of 144 and could offer that for that price to the German customer. Evidently, there have been better ideas. The Swiss could offer for 127. Now, if quality, as we assumed this, and the costs are identical, it's clear that in that situation, the German enterprise owner is absolutely favored by the customer. The Danish could directly stay at home, the Swiss probably too, because too expensive, not competitive, just because of that second tax which came on top. So where would now the client purchase? The answer is the foreigners have no chance anymore, and this is just a consequence of them being taxed at home, because they would now bear a double taxation with indirect taxes, and the others, the inland suppliers, so here the German supplier, would only bear a single tax, and this is absolutely chanceless for the others. So a legislator of the other countries must draw consequences. So what about this? As everybody knows that if I export a good to another country, there it will be taxed with the local taxes. I have only the chance to leave my exports untaxed, because otherwise I have a double taxation which directly kicks my suppliers out of the foreign market and ruins my industry. So the evident conclusion is renounce on taxing your exports. Then the situation might become fair, and indeed that's the case. You see again the German here in his own country offering for 119, and the Danish and Swiss sitting behind the borders and waiting for that chance. Customs duties is waiting for them, and now let's see what the situation brings along. No taxation in the country of origin now, so 0 and 0. At the border they arrive both with a net price of 100. Now the importation tax comes on top, that's 19 and 19. And now our Danish can offer for 119 and our Swiss can offer for 119. Big surprise, all the three have identical costs and can, after tax, offer for identical prices to the German customer. So congratulations, that would be a way how the system works. Equal chances for all suppliers. Competition neutrality achieved. We have obtained the result which we want to have. So great success, celebrations. In the combination of these two principles, you can be sure that your system works. So two conclusions which you can draw for international cases. First, in case of an export, the country of origin may, can, and must never levy value-added tax or other indirect taxes on the exports. Otherwise, you can directly forget about the whole idea of export. Therefore, you need to regulate somewhere or somehow that an indirect tax can only be levied in the country of destination where the good goes to, in all international cases. The only deviations which you can perhaps allow is those for simplification. And it's indeed an unwritten or very often even a written principle of all indirect taxes that taxation only happens in the country of destination, that exports shall be tax-free and imports shall be taxed at the border. So we generally speak from the basic principle of taxation in the country of destination, that is, where the good goes to, there it will be taxed. And this was enough for a beginning for today, and we are going to continue that with something on competition neutrality in the chain of entrepreneurs. That will you now then make understand why we have such a system where everyone pays value-added tax, every business owner, but that they can also get a refund for the input tax, the tax which is contained in the prices of the goods which they bought. Okay, so that was sufficient for today to give you a start, first idea and impression of value-added tax, and see you again soon. Enjoy the rest of the day and see you again next time. Thanks for watching. Recommend this channel to others if you like to. Um, Perhaps it may help. Okay, ciao.